This is the study session on equity investments and the reading on security market indexes. It's tempting to think of market indexes as just kind of a boring old Dow Jones Industrial Average or the S&P 500 index with a collection of 30 stocks or 500 stocks, but there are lots and lots of subtleties in here. The LOSs ask us to do things like define and describe and to compare, but there are also some calculate. We need to make sure that we're aware of the differences between and among the different types of indexes so that we can use them effectively and appropriately as benchmarks against which to compare the performance of our portfolios. So let's get right into the first LOS. Describe a security market index. There's a list of some global, popular, and commonly used indexes. And I want you to think of these indexes really nothing more than a portfolio of individual securities. And those individual securities are known as the constituent securities in the index. Now, this index is going to represent the performance of a particular asset class or a market or a segment of the market, and it's going to have a numerical value. For example, here in January of 2019, the Dow Jones Industrial Average is somewhere around 23,000. Now, the index return can be calculated using either the price index or a return index. And the difference between the two really is how each one treats the income generated on the individual securities inside of the portfolio. The price index uses only prices. The return index, on the other hand, uses prices and income, which means the dividends from shares of stock and the interest payments from the bonds. And so remember the difference between those two. Let's go ahead and calculate and interpret the value, the price return, and the total return of an index. So let's start with the value of a price return index. And so what we're going to do is we're going to sum the product of the individual prices of the securities that are inside of the index, the price of the constituent securities, times the number of units held inside of that portfolio. And we're going to sum those from I equals 1 to n. Maybe we have 10 stocks, maybe we have 100 stocks, and we're going to divide by something known as the divisor. And that's going to give you the value of the price return index. Let's talk a little bit more about the divisor. The divisor is initially chosen at inception, and it's chosen so that the price index has a convenient initial value, like maybe 1,000 or 100 or 1,000,000. That's probably too high. But what happens then over time is that the constituents might change. The constituent firms might have a stock split or a merger or a stock dividend, which is going to cause the price to change of that constituent stock. So the divisor has to be adjusted over time. And let's see how this works. We have an index with two constituent securities, stock A and stock B. Stock A has a price of 50, stock B has a price of 100, and we're holding 50 units of A and 30 units of B. All right, so let's go ahead and do some good calculations here. First thing we need to do is figure out what the value inside of the portfolio is. So multiply the 50 times 10 and the 30 times 100, that gives you 500 and 3,000. So the total portfolio value is 3,500. Now let's just suppose that we want the initial value of the index to be $1,000, so our divisor is going to be 3.5. It's as simple as that. How about the price return versus the total return? Notice in that price return, we're just taking the difference between the two prices. That's just really an F over P minus 1 in that top formula. But in the bottom formula for the total return, we're taking F over P minus 1. But before we do the F over P, we're going to add the income of all of the securities inside of that index during that time period. And so in order to calculate the total return index, you're going to have to make sure that the dividends, remember, firms don't pay dividends exactly on the same day. So you might get some dividends on Thursday, some dividends on Tuesday, and some dividends next Friday. So you'll have to sum those during that course if you're doing this over an extended time period. Here's a good example. Let's suppose that we have 5 constituent securities. with a divisor that is just 1. So we have units, and those are billions. Remember, those are kind of like outstanding shares. There's a beginning value and an ending value, and then a dividend. So 4 of these stocks, 4 of these constituent securities pay a dividend. 1 does not, the Dane tree. And so the question then becomes, wow, how can we compute the value of an index? How can we compute the return based on the price return or based on the total return? All right, so what we need to do first is figure out the beginning values. So all we're going to do is multiply the units by the beginning value. So that's, let's just do a couple here. That's 5 times the 107, and then 7.75 times the 55. And we'll just do that all the way down column A and B. And then we'll do that for the ending value as well. We'll take column A times column D, which is the ending value. And so let's just do a couple of those quickly. That's 5 times the 116 and 7.75 times the 62. And you work your way down, multiplying column A and column D. And so notice essentially what's happened. If this were a real portfolio, we would have invested 1866.25 units of a currency, and we would have ended up with 2115.75. But then we received a dividend inside of that. So we're going to take the units times the dividend. So that's column A times column C, and we'll add those dividends of 39.10. Now the price return ignores that income. We know that from a previous slide, but the total return does not. Price return 13.37. Total return is 15.46. If you need to pause the video to go back and do the math, this is important because notice the LOS does say to calculate. And so you're going to have to be able to do this. Go ahead and pause the video if needed. All right, the next LOS asks us to describe the choices and issues in index construction and management. And so this is the subtlety that I was talking about in that very first slide. Let's ask a couple of questions here. What is the target markets the index is intended to measure? So depending on the index, the target market may be defined broadly, or it might be defined narrowly. So the broad market might sound something like, hey, we'll just take any stock that's out there. But a more narrow target might be, hey, we only want Pennsylvania stocks. So then the next question is, how do we select those securities and include them as constituents in the index? Now here's where we get into this whole discussion about full replication and sampling. We won't have that conversation today. That's for a different study session. But what we can do is we can include all of the stocks in that market or just a representative sample. The next question is, how should those constituent securities be weighted? Should we do an equal weighting? Should we do a price weighting? Should we do a value weighting? Or should we do some other kind of weighting? Maybe like a factor-based weighting. How often should the index be rebalanced? Well, that depends on the type of index. We'll talk about that in just a few slides. And then when should the selection and weighting of the securities be re-examined? And I have some good examples about that later. All right, so what was this LOS? Describe the choices and issues. So I've listed a bunch of those issues and choices that the index creator must consider. All right, so here's a couple of good slides on the different weighting methods. So we'll start with price weighting. It is a simple arithmetic average of the prices of the constituent securities included in the index. The problem with the price weighting is that it has a bias towards higher price stocks. In other words, the higher price stocks influence the index much more than lower price stocks. Let's just take a quick example. Suppose I put together Jim's price weighted index and I have 3 stocks in there. Stock 1 sells for $1, stock 2 sells for $2, and stock 3 sells for $1,000. Well, the movement of that $1,000 is going to $1,000 stock is going to dwarf the movement of the other 2. Now, remember a few slides ago, we talked about the importance of the divisor. And so what's going to happen is that we're going to have to adjust the divisor for things like not just stock splits, but also stock dividends and some change of control transactions. The Dow Jones Industrial Average is a price-weighted index, and that divisor changed pretty regularly. All right, here's an example. Let's suppose that we've got three stocks, X, Y, and Z, and their prices today are 20, 30, and 70, and then their prices tomorrow or some other time period are 30, 25, and 80. Well, let's go ahead and compute the price-weighted index. And so we're just going to divide by 3 in this case because there are 3 stocks. And we're going to get 40, and then we're going to get 45, so that return is 12.5%. Equal weighted portfolio is a method that assigns equal weight. So the weight is 1 over n. So if there are 2 stocks, then the weight is 50% each. If there are 100 stocks, then it's 1% each. Here's a good example. Let's suppose we've got stocks A through E. There are some shares outstanding. There is the opening price. There is the ending price. And there is the individual return for each of those securities, 10%, 40%, 25%, minus 44%, and a minus 20%. So at the end of December, our equal weighted index is the total value at the end of December 31st, which is 10,000. Divided by the divisor of 10. Look up at the top, there's the divisor of 10, so that's 1,000. And then at the end of January, the values sum to 10,220 divided by 10 gives us 1,022. So the index December was 1,000, then it went up to 1,022, and that's a return of 2.2%. Now just remember that initially that divisor is set at the December 31st value. And so that divisor is 10. How about market capital weighting? The weights assigned to each constituent security is determined by dividing its market capitalization by the total capitalization. And so essentially what's happening is that we're seeing how much value each individual constituent contributes to the total value of the portfolio. All right, so here we've got these 5 stocks, and so we've got their shares and opening prices. So their market cap is 20,000 and 20,000 and 16, 25, and 75. If you sum those, you get 156,000. All right, and so the weights then are going to be determined by the market cap. So 20 divided by 156, that gives you the 12.8. And the 16 divided by 156 gives you the 10.25, and so on. And you do the ending price as well, and there are the individual returns. And so if we had started with a base value of just 1,000, then the ending index value, this is pretty easy to calculate, just take the ratio of the two. So what did we do? We started with 156 and we ended with 144, so that's a decline, right, in the performance of those 5 stocks on average. And what that does is it declines our index value from 1,000 down to 923. Now note that this market cap weighting, we've got the market cap of stock of security E has 75,000. Now that's 3 times, right? Even more than 3 times the value of the other 4 stocks. And so even though that lost just 20%, that had a greater influence on the index than the other ones. How about a float adjusted market cap? So for some companies, float adjusted and non-float adjusted, the index would be the same. But some companies have an ownership structure in which maybe the founding members of the company own shares, and maybe it's in a trust, and maybe those securities are not available for sale to the general public. And so the float adjusted market cap weighting removes those shares. So founding shareholders, governments can own shares of stock. And when governments buy shares of stock, they hold it for a long, long time. They don't make them available on a daily basis. So the market float is the number of shares that are available to the investing public. And so these float adjusted market cap weighted index reflect the potential trading volume on the floor of the New York Stock Exchange rather than the total number of shares outstanding. Now, fundamental weighting is something that's relatively new. What we're going to do is we're going to weight our constituent securities by certain factors. And in some future readings, we're going to learn about factors that relate to specific characteristics or factors inside of a company, like book value or earnings or dividends. And what we can do is we can tilt the weightings one way or another. We can create an index that is for income investors, and we can increase the weight to those firms who pay higher dividends than others. And this will then make the index more attractive to shareholders who would like more income versus capital gains. Now, this LOS asks us to describe rebalancing and reconstitution. So what do we mean about rebalancing? So we're going to adjust the weights of the constituent securities on a regular basis. Think about this. If we have a price-weighted index, and let's just take a simple example. We have three constituent securities, and each of them sells for $10. So we have 10 plus 10 plus 10, and we divide by the divisor, and we can get the index value. But let's suppose, and note that they're 1/3, 1/3, and 1/3. But let's suppose that stock 1 falls down to $1, stock 2 stays the same at $10, and stock 2 stays the same at $10, and stock 3 goes up to $100 or $200. Well, then what happens? Well, then that third stock totally dominates the performance of the index. And so we'll have to rebalance to get back to the original idea. Reconstitution is the process of changing the constituent securities. The Dow Jones Industrial Average is an index of the bluest of the blue chips, 30 stocks trading on the floor of the New York Stock Exchange and even the NASDAQ index. And so sometimes those change. And there's mergers and there are acquisitions, and sometimes firms they go bankrupt, and sometimes firms shrink in size so that they're not really reflective of what the index was all about. What I've done on the next page, and that's the link right there for those of you who want to go to that. Here's the link. Here's the rebalancing and reconstitution of the Dow Jones Industrial Average for the last 90 years. And so if you read down that left-hand column, you'll see there were the 30 stocks 90 years ago. And then over on the right-hand column, there are the 30 stocks recently. And you can see the columns in there of who was substituted in for what stocks. All right, why are we using these security market indexes? And so this is what I said earlier, that a primary role of security market indexes is to use them as benchmarks, plus a couple of other things. So let's talk about those other things. We can gauge market sentiment. Of course, if you watch the news every night at 4 o'clock or 5 o'clock, whenever you turn the news on, and they lead with the story from the New York Stock Exchange, and they say, oh my gosh, the bulls are out, and everyone's celebrating and there's fireworks. Or if they say, oh my gosh, the bears are out, everyone has sad faces and the traders are running their hands through their head. And so of course, the performance of these indexes will give us a sense of what investor confidence levels are and about market sentiment. These indexes, they play a tremendous role in the use of financial models, like the capital asset pricing model, and some people use the S&P 500 index as a proxy for the expected return on the overall market. And of course, other indexes act as proxies for other asset classes. Here we go. This is what I was talking about, the actively managed benchmarks. They can be very useful in judging the relative performance. And here's the classic example. Suppose you have a client comes to you and says, hey, here's my money. I need you to generate a 10% return during the next year so I can do all of this stuff with my capital. And so you put together a portfolio and you generate 10%. And at the end of the year, you tell your client, hey, you wanted 10% and you got 10%. And your client looks across the street at his neighbor, and his neighbor has a brand new John Deere tractor and 2 brand new cars. And the neighbor generated 20%. So we need to make sure that we use these indexes as appropriate benchmarks. And then the security market indices are also used to model portfolios. How about types of equity indexes? How about a broad market index? So the broad market index is the term used to describe the broad market, which means that there's stocks from every industry and every sector out there. There's a good statistic. It usually contains about 90% of the market's total value. Common broad market indexes are the Wilshire 5000. And by the way, here's another piece of useless information. The Wilshire 5000, when it was created, did not have 5,000 stocks in it. But over time, the number of stocks increased to over 7,500 at one point about 15 years ago. And now it's down to, I don't know what the total number is in the Wilshire 5000, maybe 3,800 stocks, but it's not 5,000. So don't think Wilshire 5000 has 5,000 stocks, even though it sounds an awful lot like it ought to. How about multi-market indexes? So what these indexes are, a collection of securities from different countries that will reflect different types of markets and different types of investing. There are sector indexes for healthcare and financial and consumer goods. And there are style indexes. And this becomes really, really important, especially in level 3. So we've got portfolio managers who form a portfolio maybe by investing in a majority of value stocks. And so we're going to need an index that is value oriented. And these style indexes can be all sorts. We'll talk about that Morningstar box in a later reading. Now, up to this point, we've talked mostly about equity indexes, but of course there are fixed income indexes. And so these act the same way. There's the same kind of construction and constituent securities and reconstitution that we just talked about in the last multiple slides. How about indexes representing alternative investments? This is really fascinating stuff. Alternative investments usually historically kind of meant, okay, let's invest in a real estate investment trust, or let's get a group of investors together and maybe we'll buy an apartment building. But now with the advent of hedge funds and the availability of commodities, there are tons and tons of alternative investments. And one of the there are a couple of really cool indexes that describe alternative investments. There's an S&P luxury index that I think it has 80 stocks in it, and these are companies that produce or manufacture or distribute luxury items. There's also an index called the Knight Frank Luxury Index, and this is really kind of a cool thing. What it does is it provides a rate of return on things like fine wine and vintage automobiles and stamps, and I think even furniture is in there. So yes, of course, there are indexes for alternative investments. Now let's compare the types of security market indexes. All right, so they're going to represent various asset classes, including, the equity and fixed income and alternatives. But there are hedge fund indexes, there are mutual fund indexes, there are really any index that you can think of out there. Now, the equity indexes are very liquid. Fixed income indexes are probably a little bit less liquid because, you can go to the New York Stock Exchange and there's lots and lots of people willing to trade Procter & Gamble stock. And you can go to the U.S. government securities market, and there are lots of people willing to buy and sell treasury bonds. But when you get into some of the corporate bonds and some other bonds, there is limited liquidity. And that takes us through security market indexes. So hopefully you catch a little bit of the subtlety. Maybe I piqued your interest on studying this. Really good questions that can come out of that reading.